Hello, everybody, and welcome to my weekly live stream. This is my Financial Friday. I'll be doing this every single Friday until the end of the world. Okay, maybe not, but I want to give you as much information as I can and really help educate my past clients, my future clients, and my current clients on anything and everything that you need to know about wealth building through real estate. And today's topic is really focused specifically on that topic of building wealth through real estate. And I want to, first of all, thank you for joining me. This is going to be on the topic of investing and buying investment properties. And should you buy investment properties or not? Is it a good idea? Is now a good time? We're going to talk about a lot of those things. I also want to encourage you to follow me on YouTube. So go to youtube.com/John Lone King. Subscribe, click the little notification bell next to it once you're subscribed, and that will give you notifications every time that I post a new video. I do 2 video live streams a week, one that is focused on realtors and industry professionals, and one that's focused on my clients and consumers. So I'm looking forward to really helping you guys to educate you, and I have lots of other videos that I put out there as well. Hey, Kathleen, thank you for joining. I see you there on LinkedIn this time. Love it. Joining me from a different platform. So today we're going to talk about how to buy investment properties. There's a lot that goes into this, so I definitely want to encourage you to ask questions. If you have things that you don't understand, if you're watching live, post it and I'll address it on the live stream. If you're not watching live, then post a comment, shoot me an email. We're here to help. I want to help guide you through this process and help you decide, is it a good time to buy investment properties? Should I do it or not? And so let's go ahead and dive in and talk specifically about how to buy investment properties. First thing I'll tell you is it's a challenging world. It's a challenging market that we are in. There is a lot of uncertainty, and investment properties are one of the biggest risk loans that we do. When we think about the lending world, everything in loans is about risk. It is about what are the chances that we're going to get paid back, and what are the chances that we lose money if this property ends up having a problem going into foreclosure, something else. Is it possible we're going to lose money? Thank you, Justin, for sending the love. Is it possible we're going to lose money? And so that's really imperative that you understand that lenders think of risk in categories, and not just the fact that there is market risk inherent, but an investment property is the riskiest type of a loan that a lender can consider, at least a home lender, because investment properties are not the house you're living in, obviously. So think about it this way. If you have a financial concern and you own 3 homes, you own your primary home, you own the vacation home that you guys travel to in Tahoe every winter and summer, and then you have an investment property, and the tenant moves out of your investment property, you can't re-rent it, and you end up that I can't afford to make all 3 payments. Well, then which house are you going to let go of? You're going to let go of the investment property. That's how the mortgage industry looks at this, and it makes it a significantly higher risk for us because it's not emotional. And that's actually super important tactic I want to point out. When you are buying investment properties, do not be emotional. This is a business decision, which is totally different if you've only bought primary residences. Everything that you bought up until now has been an emotional decision. It's been, I would love to live there and I can picture myself living there and it's the perfect community, and all those things are super, super important, but not when you're buying an investment property. And that's critical to understand that that's how the bank looks at it as well. We figure you're looking at this as a business decision. And with as challenging as the market is right now, we are heightening our concern, not because of home values. I get a lot of people asking me questions, John, are home values going to drop? I've got another video that I'm posting today that is going to talk about where we are in the market and what's happening right now with interest rates going up so much. And everybody says, oh my gosh, is a crash about to come? Have we seen the highest prices we're ever going to see in house prices? I won't divulge what I said because it's only about a 5-minute long video. So if you're sticking with me for 60 minutes right now, you can watch that video on YouTube when I release it this afternoon. 5 minutes long, and it's really, really good information about where the market is going and what my thoughts are. To be clear, I can't predict the future, but little secret, I don't expect to crash. Like, we're not in a position where the market is going to crash by any means, and I explain all of that in that video. But the mortgage industry has to think about what is our worry in losses. When somebody buys or finances an investment property, we are more likely to lose money, and therefore it has a higher level of scrutiny when we go through the mortgage lending process. So that's super, super important to understand. Let me talk high level real quick, a little bit of self promotion. I want to talk about Summit Funding, who we are and what makes us different. And this is critical as you think about buying investment properties. The first thing I'll tell you is Summit Funding is a national mortgage bank. We are about the 25th largest mortgage bank in the country. What that means is we don't use third parties. I don't use a middleman. I am the source of the money, not me personally, but my company is the source of the money. We're getting it directly from Fannie Mae or Freddie Mac. We don't have to go to outside banks to get our money in most circumstances. Three big things that I focus on in my business and that the company focuses on first and foremost is communication. It's providing information like what I'm giving you today to be proactive and educate you and really give you the knowledge you need to succeed. The second thing is we think we give the finest client care in the lending industry. Guys, the industry stinks. Like it's really, really bad. So I'm not saying that this is going to be an easy process. As a matter of fact, I tell a lot of my clients going through the home loan process is like flying in an airplane. There's going to be turbulence. That is not the sign of a bad pilot if you hit turbulence. The bad pilot is somebody who doesn't tell you that we're about to hit turbulence and they just serve you hot coffee and you spill it all over yourself. That's a bad pilot. But a pilot cannot control the weather. A loan officer cannot control the process as much as we would like, and there will be turbulence through the process, but we make sure that we're communicating clearly and often. The third thing is timely closings. That's super important, especially in this market right now. It is still a seller's market. Even with interest rates going up, even with people talking, all the news articles right now are saying we've passed the peak and that sellers are lowering their prices. First of all, real estate is local. Real estate, thank you, Kathleen. I got to post this one. So, Kathleen says, I do a fantastic job for their clients. Thank you, Kathleen. I appreciate that very, very much. So, guys, real estate is local. And you got to be really careful about listening to the national media on what's going on in the individual markets. So, what I talk about in my videos are mostly about what's going on locally, a little bit of a hint of what I see happening big picture nationally, but do not allow for national headlines to drive local decisions. My point is, in a seller's market, a buyer has to be competitive and perform on time, and that's a super important focus for us. And we want to make sure we give you an amazing experience. I told you that the the bar is really low for lending. 68% of people that were surveyed by Fannie Mae were dissatisfied with the home loan experience. And it's important for you to work with someone who really understands that this is a broken industry and that we've got to do extra to make sure that we're making this a great process for you so that you become a raving fan of our business. So let's dive into the meat of what you showed up for. Is now a good time to buy investment property? Guys, that's a loaded question. I'm going to park on this for a few minutes. I'm going to talk a lot about this. There's a lot of things you have to consider right now. First of all, the cash requirement to buy investment properties is very, very high. The smallest down payment, I'll talk about this in detail a bit lower, but the smallest down payment is 15% of the purchase price, and prices are pretty high. So a lot of people are worried, hey, John, first of all, I'm going to buy a $500,000 home. And if it's a single family home, you can get as little as 15% down. But you're going to have mortgage insurance that's super expensive, rates are high, and you're going to be in a position where you're likely not going to cash flow. So you have to decide, is this a short-term or a long-term play for me? Am I looking to buy investment property for long-term wealth? And do I have any cash flow that I'm willing to invest on a monthly basis towards that long-term wealth? Let me give you an example. If you buy an investment property that has a $3,000 a month payment and the rents are $2,500 a month, you're negative $500 every single month. Now you'd say, John, why in the world would I do that? First of all, rents are likely to continue increasing. And so you're going to make a significant amount more down the road. But secondly, is you're investing $500, the renter is paying the other $2,500, and you are paying down your mortgage in 30 years, you will have 100% equity in that property. You will owe nothing. It doesn't matter what house prices do in the meantime, whether they go up or down. Let me rewind and ask you a different question. If you had the ability to go back in time right now and go to 2006, the peak of the market before we had the crash. And you could go back to 2006 and you could buy a home in 2006 knowing that house prices were about to drop. Would you do it? So I see there's about 7 or 8 of you right now watching live. So tell me, John, yes or no? Yes, John, I would buy in 2006. No, John, are you crazy? I wouldn't buy in 2006 because I know that prices were about to drop. So don't be shy. Post for me if you're watching live. If you're watching on a replay, go ahead and post right now anyway and tell me, yes, I would buy, or no, I would not. All right, so we're getting some mixed answers here. A couple people saying yes, a couple people are saying no, they wouldn't buy. Here, one says, John, are you crazy? No, I'm not crazy. I haven't given you my answer, so how do you know if I'm crazy or not? Here's the reality. For those of you who haven't answered, you don't follow directions very well. So I'm disappointed. I'm watching you, and you didn't answer, even though I told you to. Thanks, Kathy. Again, there's another answer. I got a couple more answers in here too. All right, so everybody says no, they wouldn't buy in 2006. But let me ask you a question. If you could buy a house in 2006, knowing that you had a $2,000 a month house payment and you were buying this house for, $300,000, I don't care what the numbers are, and that you were going to collect, $500 less in rent than what your payment was. So you're upside down in your rent income as well. That $300,000 house in 2011 is worth $150,000. Thanks, guys. I got more people responding. Appreciate that. It's worth $150,000. You're like, John, that's why I wouldn't buy then, because I would rather buy it when it's at the $150,000 number. Well, first of all, that requires that you knew exactly where the bottom was going to be, and nobody ever hits the bottom. A lot of people think they're timing it and think they're going to hit the bottom, but you can't know. We don't know whether we're at the top either. But guess what? By 2016, prices were pretty close to where they were back in 2006 on a national average. And you have been having consistent increases to your rents that you were able to charge from 2006 to 2016. You also got a significant amount of tax write-offs and tax benefits in the meantime, and you only have 20 years left on the mortgage. Now we're in 2022. It's now been 16 years since 2006 when you bought that property. You only have 14 years left on the mortgage. In the last 5 to 7 years, we've seen rents skyrocket. Now you have huge cash flow. You have cash flow being positive income coming in. You have a huge amount of tax write-offs that you've continued to get off of that property. And in 14 years, you owe nothing. That is the leverage. That's the value of buying investment property. I believe if you're doing it for the long term, there isn't a bad time to buy. Because as long as you have a fixed interest rate, that's the key. By the way, adjustable rate mortgages are about to come back into fashion. I heard my first radio ad this morning as I was driving into the office, telling people how amazing it is to have an adjustable rate mortgage because nobody keeps their loan longer than 10 years. And why do you want to have a mortgage that is longer than what you need? We can get you an adjustable rate mortgage that keeps your rate fixed for 10 years. That's going to become a bigger, prevalent part of the market as interest rates go up. Be cautious. I will tell you that if cash flow is super, super important to you right now, adjustable rates really aren't that much less expensive than fixed rates, but they will become. As we get deeper into the economic challenges we're dealing with inflation, with the oil issues, all of the stuff that's going on globally, we're going to see fixed rates continue to go up and adjustable rates will stay the same or potentially drop a little bit, but that's a big risk you're taking. The reality is, I don't know that it's a bad idea if you're going in eyes wide open. What I'm worried about is we're going to repeat what we did in 2003, 2004, 2005, which is exactly what Kathleen is saying. No, stop the train. Adjustable rates are not good. They're not bad if used the right way. You have to be able to afford the payment. So if you could afford to put the extra $500 in, but Kathy asked that question, is that ever a good idea? So Kathy, I appreciate you asking that question. Yes, there are times when it's a good idea. If you have the extra income to be able to afford to cover the $500 short, but you can instead put that money into a different investment and save that money, then you have the what's called an opportunity cost, right? You have the money tied up where you put in $500 a month to cover your negative rent, or you get an adjustable rate mortgage and you don't have that 500 and now you can use that $500 somewhere else. This is about wealth management. It's about financial strategy. It's about decisions like, should I cut back my investment in my 401k? Now, I think 401ks are super critical to your long-term wealth. Super, super critical to your long-term wealth. So am I an advocate of cutting back your 401k? No, not at all. But if all of the other boxes are checked and you say, hey, I can do an investment property, this works for me, but I can't cover the extra $500 that I'm negative unless I slow down my investment in my 401k, then I would say slow down the investment in your 401k. And it's for a reason called leverage. Leverage says, hey, I'm going to put $20,000 in my 401k this year. If you put $20,000 in the 401k and it grows by 10%, you've gained $2,000. But if instead of taking that $20,000 and putting it in your 401k, you only put in, $8,000, and you take $1,000 a month less in 401k contributions, and you use that extra $1,000 to help afford to buy a $400,000 investment property. If that investment property grows by 5% in appreciation, which is an average number. The truth is, over time, houses typically, especially in California, are averaging 6 to 8% appreciation across all markets. So follow me here. You could put 20 grand in your 401k and it would grow. If it grew by 10%, you'd gain 2 grand. But if instead you bought a $400,000 investment property that grew by 5%, you've actually grown $20,000 in equity because it's 5% of the $400,000. That's giving you leverage. And you still put 8 grand into your 401k. You just didn't max it out for 20. I don't ever want somebody to stop putting money in their 401k, but it is about juggling your decisions on where you're putting your money and buying real estate. This holds true also buying a primary residence. As interest rates are moving up, and as we are in a position where people are concerned affordability, I can't afford to pay for what it's going to take to become a homeowner. We got to think about, where are we investing our money? Is it smarter for us to invest money in different places and stop investing as much into our 401k as an example, and divert some of that investment into a residential real estate investment? Leverage is super, super critical. I appreciate that, Haxar. You like that one. I do too. I think that's really important to understand leverage. And that has nothing to do with timing. All right, so Kathleen asked a question. By the way, guys, you have questions, please post them. I will address them when appropriate. So she said, should someone refinance and take out some of their equity in order to buy investment property? Maybe. That's going to be a case-by-case basis. I have another video on YouTube called should I do a cash out refinance or a home equity loan or a home equity line of credit? What I'll tell you is over leverage can be scary, especially over leverage with adjustable rate mortgages. Now we start getting into the territory that caused the market crash back in 2008. And that is what I'm a little bit concerned about, that my peers are going to sell these adjustable rate mortgages as, hey, here's a solution for you to get into a house with a reasonable payment that you can afford. But the problem is that there's no guarantee we can refinance it down the road. And that is exactly what caused the market crash back in, that's what caused the domino effect back in 2007, 2008, is everybody could not refinance the next property. My neighbor lost their home. Because they lost their home, home values dropped a little bit, but they dropped enough that I can't refinance my home. I didn't need to. Oh, wait, I do, because I have an adjustable rate mortgage and that rate's going to keep going up and I can't afford my payment anymore. So I'm out, and that created a domino effect. So Kathleen, to tie this back to your question about refinancing and pulling out equity, I think that is one strategy that we look at. That is for sure, the best spot for current homeowners to tap into, because we've had such a significant appreciation over the last few years that is a much better use of the equity in your current home than to use it to pay for a round the world cruise with you and your spouse. I'm not against cruising, but you got to be careful about where you're spending your money and are you investing it in wealth long term. But yes, refinancing and taking some equity out of your home is definitely an option for you to be able to uh, uh, leverage and to purchase real estate. Guys, I told you I was going to camp on this slide about is it a good time to buy investment properties for a few minutes. I'm almost done. I want to summarize this. I got a lot more to cover in details over the next 40 minutes, but what I'll tell you is um, it is, in my opinion, always a good time to buy investment properties as long as you've got a payment that you can afford and make sure that you know what the negatives are. And I'm going to cover the negatives here in a couple of minutes. So let's talk about the pros and cons of investment properties. Depreciation. Depreciation is funny money. Depreciation is basically your investment property is being treated in the eyes of the IRS as a business tool. And if you have a work truck, you buy a work truck because that's your job, and you are a delivery owner of a delivery company, and you buy a $50,000 work truck. The IRS says, hey, that work truck isn't going to be worth 50 grand when you're done. As a matter of fact, it's going to be worth maybe 10 grand when you're done. But you're using up the value of what you paid for that truck each year as a cost for the income that you brought in. And so they take that work truck and they'll divide it out by 5 years as an example. And let's say, okay, you get to depreciate $10,000 a year of the value of that truck, because when you sell it, you've used the value. You've got wear and tear on it. It's going to be worth less money. It is a tool that was used to make money. Now, the interesting thing about real estate is real estate doesn't lose value like a work truck, but the IRS lets us treat it that way. So the IRS says, hey, you're using this home, you bought the home, and you're using the home to generate this income. We get to depreciate or decrease the value of the home over time, and it gives you a bigger tax write off. That's super, super good. Here's the other side of it, though. You have to make up for that depreciation when you sell it. In other words, with your primary home, you can buy a primary home for 500,000, sell it 3 years later for 700,000 and you pay no taxes. On an investment property, you buy it for 500,000, you depreciate it, you write off $100,000 worth of that value over the next 10 years. And now the IRS says, great, then that means that you bought it essentially for 400,000. And now you're selling it for 700,000. Instead of having $200,000 in taxable income, you have 300,000. So depreciation does catch up with you only when you sell and you do not use a 1031 exchange. 1031 exchanges allow you to sell one investment property or multiple and buy another investment property or multiple. You're trading one for the other and you're not paying taxes on the sale. I'm not going to get into detail about how a 1031 exchange works, other than simply saying that if you buy investment property and you're doing it for the long term, you can trade one for the other unless the IRS changes the guidelines. They've threatened multiple times to change the guidelines on 1031 exchanges, so be careful, because there's no guarantee that the federal government is going to maintain that rule. But just like the mortgage interest deduction, there's no guarantee they're going to maintain that rule either. But it is very hard for them to get rid of, because so many people use it on a regular basis and freak out if they say, hey, I'm going to get rid of 1031 exchanges, or I'm going to get rid of mortgage interest deduction. The National Association of Realtors and lots of other lobbyists are fighting that on a regular basis. So depreciation is a good thing. And if you have high income, depreciation helps you to save a lot of money on your taxes. The second pro, someone else makes your mortgage payment. Guys, seriously, like, you're gaining equity in this property. It's going to be paid off in zero balance in 30 years if you don't refinance it. And somebody else is writing the check. That's super, super important. So Rosemary asked a question about this. Let me pop up the question here. She said, can you trade in California to a property in another state? First of all, I'm not a tax advisor. I don't give tax advice. I can't give tax advice. My understanding is 100% yes. Matter of fact, I had a client that I did a loan for back in November that had sold a lot. They had a bare lot that was used for commercial purposes in the Bay Area, on the peninsula. They sold the bare lot for $2 million and purchased an industrial warehouse in Arizona for the same $2 million. Now, good timing. Buying land they stopped making land a long time ago. So buying land can be good. Super scary though. There's some concerns about land, but in their case, it worked out really, really well. They sold that property on the peninsula. They bought a property in Arizona. It generates, I want to say, $20,000 a month in rental income for them on that commercial industrial property warehouse. Actually, I think it's a tech center where it's like a technology company, manufacturing technology, chips, stuff like that. I don't really know the whole details, but they absolutely did a huge win by selling that property in California, doing a 1031 exchange to Arizona. Again, not a tax advisor, cannot play one on TV or on the internet, but I have evidence of my clients doing that, and you're very welcome, Rosemary. Okay, so appreciation. Guys, we talked about this already. I'm not going to go too deep into it, but leverage and the ability for home values to appreciate over time. It is not about timing the market. Kind of what I talked about earlier. Is it a good time to buy? It's not about timing the ups and downs of the market. It's about time in the market. How long are you in the market? The longer you're in the market, the more you're going to see appreciation. The next pro is mailbox money. You guys have heard that term before. It's like, hey, I'm sitting here at home, I'm doing nothing, and money just shows up in my mailbox. Over time, that's a great strategy for people to have income, especially into retirement, by having investment properties. Airbnb opportunity, that's huge. I would say that's new, but it's not really new. But there's risks there. A lot of people ran into problems with Airbnb back in 2020, thought they had it covered. They were highly, highly leveraged. I had people who I knew, I didn't do any of these loans, but I had people that I knew and read articles about some others where they had, 2, 3, 4, 10 investment properties that they had as Airbnbs, and they didn't care how much their payment was. They used hard money loans to get into these properties because they knew they could rent them out and they would cash flow really, really well. Except that the pandemic kind of changed that dynamic a little bit. Now it's coming back, but the problem is that these people were losing these homes because they banked on what is happening today will be the same forever. And that is never, ever true. Life is never as good as we think it is, and it's never as bad as we think it is. And life will never be as good tomorrow as it is today. It'll never be as bad tomorrow as it is today. Things change and there are cycles. You have to make sure you have a plan for that. So, what are the cons of buying investment properties? Evictions. There's a mentor that I had that talked about his wealth building strategies. He was in the mortgage industry. He is in the mortgage industry. And he tells a story about why he cannot be a landlord. And he said his first rental property that he bought, and the tenant was not making the payment, and he had to go evict the tenant. And he shows up, and it's a single mom, 2 kids, pregnant with a 3rd kid, and he's staring at her at the door, basically ready to tell her, "Hey, you haven't made your payment. You have to get out." And he couldn't do it. Like his heart said, I can't do this to somebody. I can't kick them out on the street. There's a family living in the home that you're treating as a business. For some people, hey, that's life. If I wasn't the landlord, somebody else would be the landlord and they'd be evicted anyway. But for other people, you got a heart. And I'm not saying that person doesn't have a heart. I'm not saying the first person doesn't have a heart. But what I'm saying is some people can't get over the fact that this person, I'm ripping out their shelter. I'm going to make them homeless. I'm going to cause problems. Evictions are major, major issues, and you have to be prepared and willing to do that. And if you're not mentally prepared to evict somebody, then you probably shouldn't become a landlord. Repairs, guys, there's going to be repairs. And if you don't have a management company, then guess who gets the phone call at midnight when the toilet's overflowing? You do. Let's exacerbate this a little bit further. There's a strategy of buying investment properties, and this works very well, by the way, by buying a 3 or 4 unit property and you move into one of them. As a matter of fact, it's an amazing strategy to help you. I'm going to get rid of that for a second because I'm not talking about that. So this is an amazing strategy to help you buy an investment property if you don't currently own real estate and you want to be a long-term landlord, a long-term investor. Your first real estate purchase should be a 3 or 4 unit property, and you should move in because you can buy a home with as little as 3.5% down using FHA. So think about this. I'm going to talk in a couple minutes about down payment options, how much you need to have for a down payment for buying investment properties. You need a lot. On top of that, you need to have a lot of money in reserves. So how do you get on this wealth building train? How do you start building wealth when you don't have a whole bunch of money in the bank? One of the options is to buy a multifamily property. By the way, guys, you have questions, feel free to post them into chat. I'll address them as I have been for the last 30 minutes. Hopefully this is valuable. So give me a thumbs up, a like, a share. Love if you'd share this with everybody. So click the share button right now. I'd appreciate that too. So the problem is, if you own a single family residence already, we are not going to believe that you want to move out of your single family residence and convert that one to a rental and then move into a triplex or a fourplex that you're going to live in almost an apartment type of environment. And we're not going to believe you. Kathleen, I'll get to your comment in just a second. So if you're in a single family home, we look at common sense. Okay, common sense says, are you really going to move out of this home and into a 2 or 3 unit property down the street? And there might be a good situation where we say, yeah, you know what, common sense, that does make sense that you're going to do it. But it's got to be logical. It's got to be in a much better part of town. Why are you moving out of the one that you're in? And don't say, well, I'm moving in there so that I can call it owner occupied. Because once we give you the loan, you could not move in. And so we have no way of proving you moved in. We have no way of forcing you to move in. And so we have to use common sense and say, is it logical they're going to move in? If it's not logical, we won't believe you. But if you don't own any other property and you buy a multifamily property, it's logical. Hey, you own nothing. Of course, you're going to move into it. I have no problem believing you that you are going to move into that property. And with FHA, you can do a 3.5% down payment on a single family 2 unit, 3 or 4 unit property and only put 3.5% down. Rosemary, you asked, can you use conventional as well? Yes, but not with a small down payment. So even if you're going to occupy the residence as your primary home, conventional loans still require 20 to 25% down when it's a 2, 3, or 4 unit property. So the only way to do a small down payment and buy a 2, 3, or 4 unit property that's owner occupied is to use FHA, or technically VA. You could use a VA loan as well, but conventional you cannot use to buy a multifamily that you're going to live in. Kathleen said, you have some clients that are going to be selling a home to go buy a multifamily home. That's great. And I don't have any concern about that because remember, I talked about common sense. Common sense says, are you really going to move out of the house that you're in into the next one? Well, yes, because they're selling the current one. And if you're selling the current home, you'll have nowhere else to live and you'll be homeless. I don't need an explanation on why you want to move from a 5,000 square foot home to a 2,000 square foot home. That's up to you, as long as you're selling the 5,000 square foot home. But if you're keeping it and it's you and your 4 kids and your 3 dogs and your llama in the backyard, okay, maybe there's not a llama, but anyway, if you've got that large of a family and you're telling me that you're going to move from a 5,000 square foot home that you've lived in for 10 years and you're going to move into a 2,000 square foot home and your kids are young and they are just 10, 11, and 12 years old, I'm not going to believe it unless you're selling that property. And that's the key, is you have to be selling the property. So great strategy to use multifamily homes that you're going to occupy. But remember, here's why I got onto that, because I'm talking about repairs. If you buy a multifamily home, your tenant literally is connected to you. When the toilet breaks at midnight, instead of them calling you, they're knocking on the door. So be aware, be fully eyes wide open that there's going to be repairs that are going to fall on you. You have to have money set aside to cover those repairs. You also need money set aside to cover vacancies. You're going to have a tenant move out, and it is going to take time for that tenant to get back for you to replace that tenant. There might be some cost associated with that, with replacing that tenant and getting them getting the property, maybe changing out carpet, repainting, etc. So just be aware, there's time necessary for time and cost for vacancies, because you're still making the mortgage payment even when your tenant is not there. And let's not even talk about the COVID rent moratorium. that is how do I want to say this appropriately? We hope that doesn't repeat. We hope that we're never going to be in that kind of a situation. But the truth is, a lot of landlords got in trouble, not in trouble, got in financial straits, dire straits, because their tenant didn't have to pay the mortgage payment. Excuse me, the tenant didn't have to pay their rent payment because the state of California said, hey, there's a moratorium on paying rent. If you've been impacted by COVID, you can stop making your payment and your landlord cannot evict you. And so that landlord had to figure out, how do I survive without receiving rental income? Now, a lot of banks did some things to help with forbearance for landlords, et cetera, but just be aware, you bear that risk. Okay. Market volatility. I told you that there's never a bad time to buy investment properties, except when you needed to sell it in 2009. You bought in 2006. You're great as long as you're buying for the long term. Something happens and you have to sell in 2009. A, you've got market liquidity or market volatility, and B, it's an illiquid investment. John, what do you mean by illiquid? I don't like liquid. That would mean there's a flood in the house. That's not what I'm talking about. What I'm talking about is if you buy stock, you can liquidate stock in a day. It's no big deal. But if you buy a home, think about it in 2008, 2009, 2010, there were people who wanted to sell that couldn't. Like, you didn't have a choice. I need the money out of the house, but literally there are no buyers to buy my home. And so that is a major concern. And Kathleen, I agree with you. And she's talking about the COVID moratorium. And she had a lot of landlords that had to sell because of it. Like, they didn't have a choice but to sell the property. And luckily, we were in an appreciating market while that was happening, and it was a seller's market. And so it played out really, really well. But that doesn't guarantee that's how it's going to play out every time. So just be aware, market volatility and being an illiquid investment. Airbnb concerns. I already kind of talked about that. Look, Airbnb sounds great, except when it's not. And so you've got the gravy train that can sometimes come to a screeching halt. So just be aware of that fact. And the amount of cash that's required. And I'll talk more about the cash in a couple minutes. Some other considerations. Do I use a property manager or not? You're going to have a cost associated with property management. You have to budget that in. Now, it makes it a lot easier because you don't have to worry about doing the work. But if you don't have a property manager, it's a part-time job. You're chasing down rent and payments. You're paying all the bills. You're, making sure that all of the repairs are handled. You're screening all of the tenants when there's a vacancy. All of those things, that's work that either you're paying somebody else to do it or you're paying yourself to do it. Either way, it's costing you money to do that. Hey, Joe, thanks for the like. Either way, it's costing you money, whether you write a check using the property management company or whether you're paying yourself, you're still writing a check. You're costing money for the management of the home. A lot of people talking about, hey, John, should I buy with a partner? Maybe. So I'll share in a couple minutes where you can get money from for down payment and where you're not allowed to. You cannot get down payment money for an investment property from a gift. So if you've got a family member that says, hey, I'll help you out buying that investment property, I'll give you some of the down payment money, they have to be a buyer. They cannot just give you a gift. Gifts are only allowed on primary residences and second homes. So you cannot get a gift. So if the money is coming from somebody else, or some of it's coming from somebody else, they have to be a partner on the loan and on the ownership of the property. Guys, partnerships go bad. I don't care if it's family. I don't care if it's your best childhood friend. Money changes things. People have different needs at different times. One partner is going to need to sell the property and the other one doesn't want to, and they got to buy them out, but they don't have the money to buy them out right now. I've seen lots of things go bad. I've seen it work out really, really well for people. But open your eyes and recognize things will never be as easy as they are right now when it comes to your relationship with that person. Because once you add the strain of owning a property, managing a property, making decisions about that property, you run major risks that you're going to spoil the relationship and there's going to be more problems. All right, you want to always think about where the market is going, but not just the housing market. You got to think about your own personal finances. You've got to think about, hey, where am I at right now and what's happening with my industry? Am I going to be retiring soon? Am I going to be able to cover that extra amount that I need to cover that I'm short right now? Are rents rising or not? Lots of things you've got to be thinking of to just have eyes wide open about what is this the right time for me to make this purchase? And then the big question everybody always asks me every time I talk to them is, John, what's this meaning to inflation and interest rates, and how does that play into all of this? So I got lots of videos on my YouTube channel. So go to youtube.com/John Lone King. Check out my YouTube channel there. But what I'll tell you is, in all of those videos, I'm talking about rates are going to continue going up until the Fed douses the inflation fire. Inflation is horribly blowing up, and it's making everything more expensive. And for mortgages, that's a bad thing. That is our Achilles heel, because as inflation keeps going up, look, you're only paying us, even if you're paying me 5% interest every year, the cost of goods is going up by 7%. We're going backwards. We're not even, the dollar that you pay us back is worth less money every future year because inflation is greater than the interest rate that we are charging. And that's going to mean interest rates have to keep going up. And then we're going to see inflation come back down at some points. When inflation comes back down, it is highly likely the Fed will have overcorrected and thrown us into a recession. In general, with recessions, interest rates go down. That gives you an opportunity to get back the lower rate that you missed out on. So you locked in today's purchase price, you're able to refinance down the road. Recession does not lower home values historically. Now, I can't promise you anything is going to happen in the future, but I can look at the past and tell you that this is what's happened in the past in these circumstances. Recession lowers interest rates, does not lower home values. The only recession where home values went down was the Great Recession back in 2008, but that recession was caused by the home and mortgage industry. So there's a whole different set of factors in play. Cause and effect. Did the recession cause housing prices to go down, or did the housing markets cause the drop in housing prices and the recession? I argue it's the second, and that the recession did not cause housing prices to go down. All right, couple of things to think about when you're deciding, okay, John, I'm ready to buy an investment property. The first thing is find a realtor you trust. That is the single most important thing, because you need somebody who can guide you through this process. This is not for the faint of heart. This is not the same process you went through when you bought your primary home. You've got to look at it statistically. You've got to look at it numerically. Do not buy a home based on where you would live. Okay, and I'm not telling you to become a slumlord. I'm not telling you to buy a horrible home in a horrible market and not make it nice for somebody. But what I am telling you is your current home likely won't make a good rental property. Think about it for a second. Your current home may not make a good rental property. First of all, you fixed it up. You've done a whole bunch of work on it. You've made the kitchen really, really nice, and you've remodeled all the bathrooms, and you got a beautiful pool out in the backyard. A tenant's not going to pay significantly more for a house that has a pool in most situations. And so you are now having that house be run down by somebody who doesn't have the same pride of ownership that a homeowner does. Okay, Kathleen just said it's important to have someone who will look out for you. Absolutely agree. So the pride in ownership is super, super important on a primary home, but on an investment property, very few. Some, you're lucky if you get it, but very, very few tenants are going to have pride of ownership. They're not going to care about keeping everything nice. So a lot of people, their first investment property is what I call the accidental rental. Okay. The accidental rental is that home that you owned that you decided, hey, I'm going to buy another home and I'm going to keep this one as an investment property. In general, that's fine. But if you've got a luxury home, probably not a good idea. Now, granted, there are people who want to rent luxury homes, so I'm not telling you don't do it, but just understand your best investment property is not always the house that was best for you. You don't want to use the same lens that you were using to decide what is your right property to purchase for yourself as the lens to decide what is the right property to buy when you're buying an investment property. So just be aware of that when you come up with the accidental rental situation. It can work really, really well, but it can also backfire. Okay. So Kathleen, let's see what she's saying here. Never a good idea to rent out your home. She's seen clients do this and be so disappointed at how the tenant treated it, and there was so much damage that they had to fix. That is absolutely correct. Again, I'm not sure I would say absolutely correct, because Kathleen, you said the word never. Sometimes it can be. Think about it. If you bought your starter home, and it was a nice 3-bedroom, 2-bath home, nothing really fancy, and you lived in it for 2 or 3 years and you got a good amount of appreciation. Now you can pull the equity out of that home and go buy something else, and you can keep that one as a rental. That might be a good idea. you're still going to have the emotional attachment to that was my house and somebody's never going to treat it as good as you did. But there are times when it absolutely makes sense if you can make the numbers work financially. You just have to make sure you're thinking different. So what do you want to look for? Look for cash flow. Okay. I'm not saying it's positive cash flow, especially with the rate environment the way that it's going. But as we move forward and hit a likely recession, you'll be able to reset that cash flow and get the payment down. But you want to think about what is your cash flow? Am I positive or am I negative on cash flow? Think about maintenance. Okay, that's another thing is how hard is the yard to maintain? Who do I have to pay to maintain this? What amount of maintenance do we have to do on this property? Demand. What's the demand for this property? If it's a 4-bedroom, 1 bath, think about that for a second. A 4-bedroom, 1 bath. How many people are going to want to rent a house that needs 4 bedrooms, but are okay with having just 1 bathroom? First of all, that's a problem in the resale market as well. But you have to think about these things saying, what's the appetite? In this neighborhood, is this a common rental and will it easily rent? How many other units like this are available in this neighborhood? And make sure it's a neighborhood that your tenant wants to live in, not just a neighborhood that you want to live in. Depreciation. So let's talk quickly about depreciation. I talked about this a little bit a couple minutes ago. So it decreases the investment you made in your property. So it lowers what the value of the property is, not in real life, but in the eyes of the IRS. And it starts as soon as you make the property available as a rental. And just for those of you who are math nerds, the purple box tells you that it depreciates a single family residence. The calculation I got is 3.636 each year for 27 and a half years. And that was a calculation I pulled up a year or so ago. I did not update this slide, so that could be very, very incorrect. So there's my disclaimer. And the depreciation is only on the building, not on the land. So you might think, well, wait a second, I bought this thing for $500,000 and you're only depreciating 350 because the land has value. And the value of the land doesn't get used up. There's no wear and tear necessarily on the land. It's just on the actual building. So you're not depreciating the value of the land. Okay, guys, let's talk about income requirements. This is different than how you look at primary residences. This is actually really confusing for people because they'll call me and say, John, I'm ready to buy an investment property and I want to know how much do I qualify for? And my answer always is I have no idea. Well, John, you must not be very good at what you do. Well, no, I'm actually really good at what I do. It's impossible to calculate until I know how much you're going to collect in rents. So what do you think you're going to get in rent? Well, I don't know. It depends on what I buy. Well, there you go. So we're in the Abbott and Costello who's on first routine. Like I can't tell you how much you qualify for until you tell me how much you're going to get in rents, and you can't tell me how much you're going to get in rents until you know what you're buying. So we have to go back and forth a little bit. We do look at your overall income, your overall debts, but when it comes to the property you're buying, I might say, hey, you qualify to buy a $500,000 home that rents for $2,500 a month, and that's your cap. And then you say, hey, John, I found a $400,000 home, so I wrote an offer and I got it accepted. And I might tell you, you don't qualify because that $400,000 home only rents for $1,500 a month. And statistically, that $1,500 doesn't cover as much of the payment on a $400,000 home as the $2,500 covers on a $500,000 home. So let me say that again. I may qualify you for $500,000 with the assumption I'm always going to make you and your realtor give me some numbers. How much do we think we can rent this house for in a neighborhood that you're theoretically shopping? And I say, okay, you qualify for $500,000, assuming rents are $2,500 a month. You go out and find a $400,000 home on a single family residence on your primary home. It's easy. You're qualified for this much. You can buy anything below that. On investment properties, that's not true because that $400,000 home will rent for a different dollar amount. And if it's proportionally too much lower, the numbers don't work anymore. Here's the next thing. We only count 75% of the rental income. Wait a second, John, what do you mean you only count 75%? We only count 75%. So if your rents are $2,000 a month and your mortgage payment is $1,700 a month, in your mind, you have $300 a month in positive cash flow. That is not how it works in my eyes. You have a $200 loss. The reason you have a $200 loss is because your $2,000 a month in rent, we throw away $500 of that each month for repairs and vacancies. We are worried that you're not going to actually have $24,000 at the end of the year because you'll have had to spend $6,000 theoretically in repairs and vacancies. It's very uncommon that you have that much in a cost, but we have to budget for something. So I'm going to take that $2,000 a month income and I'm going to treat it like 1,500. And so that $1,700 a month house payment means you're upside down by $200 a month based on my math. That's super important to understand. I don't need you to figure out the math behind it. I need you to understand the concept so that when you ask me, John, I thought this thing cash flowed. Why are you saying I don't qualify? That's why. Okay. Now, there are other programs, and DSCR is one of them. I'm going to go this deep into it, but it's called debt service coverage ratio. If you're in a position where you need to pull cash out on a refinance of an investment property, or you have a property that you have to purchase, but your business income is down right now, but you know this property is going to cash flow really well, but the problem is you're upside down on some other properties and you've had vacancies over there and your business isn't doing as well, and you don't qualify based on looking at your overall income and debts, but you do have the property you're doing a loan on that cash flows very well, then we use this program called debt service coverage ratio, or DSCR. That's an industry term, but basically what it means is all I care about is the rental income on that property, and I don't care at all about and I care about the rent payment on that property. I don't care at all about any of the other properties you own. I don't care about your primary house payment. I don't care about your debts that you have, your car loans, anything else. As long as the rent income from that property covers the rent payments, that covers the mortgage payment, then you're approved from an income perspective. Now, these have higher interest rates, bigger down payment requirements. So it's not a simple solution that gives you exactly the same terms, but it is a great solution when necessary. All right, so let's talk about occupancy a little bit. Occupancy is very misunderstood. Basically, there's only three types of occupancy: your primary home, a second or vacation home, and an investment/rental. Primary is the house that you live in most of the time that is within commute distance of your home. A second home is not just the next house you bought. Many people confuse that and say, hey, John, I'm not buying an investment property. I'm buying a second home because I have a first and now I'm buying my second. A second home must be at least 50 miles away from your current home in a resort or vacation-like destination. The purpose, and there's a little bit of fudgeability on that. Fudgeability, is that a word? Anyway, flexibility is probably a more accurate word, but fudgeability is a fun word. There's a little more fudgeability on that 50 miles away and in a vacation or resort-like destination. But the truth is, it's got to make sense, common sense, that you're going to use this as your personal use residence for a period of time. Not your primary residence, but your personal use residence. Here's the thing about second homes, though. In the last 6 months, Fannie Mae and Freddie Mac have changed their rules, and they now look at second homes as the same level of risk as investment properties and rentals. The good news is smaller down payments on second home/vacation homes, but you have the same higher interest rates that you have on an investment or rental property. The other thing you got to consider is, hey, do I want to buy a single family? Do I want to buy a condo, 2 to 4 unit property, or a 5+ property? What I'll tell you is the first three groupings, single families, condos, and 2 to 4 units, I can do them. Those are considered residential, and I'm an expert in those. But if you're looking at apartment complexes or larger buildings that are 5+ units, that's commercial. So in that situation, I'm not going to be your banker. I'm not going to represent you at all. I'm going to connect you with somebody that I trust that can help you to decide if that's the right thing to do. I'll tell you their math works totally different than mine. How they look at the property, how they value the property. They're not looking at comps and what homes have sold for. They're looking at cap rates and rent rolls and crazy stuff that's way over my head. Just recognize you need an expert on your side if you're buying anything greater than 4 units. Down payment options. Here's the deal. I talked about this a little bit. You're looking at this is for traditional conventional loans. You're looking at a investment of on a 1 unit single family home. You can put as little as 15% down. But on 2 to 4 unit properties, you've got to have 25% down payments, and you have to have closing costs and reserves. So I'll tell you, closing costs are likely to be another $10,000 to $15,000. And we're going to require anywhere from 6 to 24 months of reserves. When I say reserves, I'm talking about the monthly payment on the home that you're buying times 6 or 12 or 18 or 24, depending upon the guidelines of the loan program that we're using. And if you own multiple rental properties, that can be exponentially larger because you often need to have reserves on all of your rentals. Now, the rental we're not doing a loan on, we only have to have 2 months of reserves on each of those properties, but your reserve requirements are huge. If you have a good amount of money in a 401k that you're able to access, you don't need to access it, but you have to have the ability to access it without quitting your job or being fired. Then we can use that 401k as reserves. If you have money in the stock market, we can use that as reserves. But they are very, very financially draining in what we have to have in upfront cash. Where can that cash come from? Savings or investment accounts, inheritance, your retirement funds. Kathleen mentioned it earlier. You can do a cash out refinance, but it cannot be gift funds. If somebody else is going to gift you money to buy an investment property, they need to be a partner. They need to be on the loan, which means I'm counting their credit and I'm counting their income and debts, or I cannot use their money. If you have money that is not in your bank that you need to use, put it in the bank and wait 2 months, because then it's your money once it's been in there for 2 months. I'm not looking beyond 2 months of bank statements. Interest rates. Guys, interest rates are, thank you. So interest rates are increased when you're buying investment properties. So the first chart that you're seeing at the top here talks about this is all what the risk is, what the cost of the risk. And I'm not going to explain it all in detail, but it has to do with what your credit score is and how much down payment you're putting. And the higher the number means the higher you're paying in fees to get that loan. But as you look way down at the bottom, you see an extra, even if you're putting 40% down, you're spending an extra 2% in fee for an investment property. And it could be as much as 3 to 4% extra in fee on an investment property. So just recognize that the interest rates on investment properties are significantly more expensive, often anywhere from 1%, half a percent, let's say, 0.5% to 1.5% higher than conventional. And in today's market, that's highly volatile and highly flexible. So just be aware, you're definitely paying a higher cost. Now I'm gonna go on a tangent a little bit here and talk about something called delayed financing. This is a phenomenal strategy for somebody who's looking to buy investment properties and they have cash, but they want to leverage that cash. So what it means is you buy the property using your cash right now. That could be a home equity line of credit, it could be cash in the bank, and then we refinance you right away. You don't have to wait 6 months or a year to pull your cash back out. And when you pull the cash back out. Rosemary, if you could explain a little better when you say even if you live in one of the units. Oh, okay, live. Yep, I'll explain that in a second. What you're talking about is the down payment requirements, or are you talking about the interest rate? Give me a little more detail on that, and I'll bring up your question. So on delayed financing, you are able to pull cash out immediately after paying cash for the property, and you can pull up to 75% of what the actual value is, and it allows you to get the benefit of being a cash buyer, put your money in there and compete because you're a cash buyer, and then get the money back out so that you can put that towards the next property. So Rosemary said, does that apply even if you live in one of the units? Okay, you're talking about interest rates. So interest rates, when you live in the property, you do not have that extra hit at the bottom. So that extra 2 to 4% does not apply if you're living in one of the units. But it does, there's an extra hit of 1% when it's a 2 to 4 unit property. So it is definitely something to be aware of. Delayed financing does not apply for primary residences, but it's great for cash buyers who want to be able to get out of the property quickly and be able to put the cash in and then get the money back out, either to replenish or pay it back into where it came from, like your home equity line of credit or the stocks you pulled it from, or leverage that to buy the next property. What I talk about here real quick, guys, is when we talk about interest rates, there are lots of things that go into the interest rate. It is not just the market rate. There's no such thing as market rate, but there's a lot of factors that go into it. Number 13 is occupancy. If you're going to live in the property, it's a lower rate. Like we're talking about just with Rosemary right now, perfect timing. If you're going to live in the property, it's a lower rate. If you're not going to live in the property, then the interest rate is going to be higher. So be aware that absolutely plays into this a lot. Guys, I've covered a lot. We're right now at the 1 hour mark. What I'll tell you real quickly is when I think about wealth accumulation, I think about it really in 5 steps. The first step is buying your primary luxury real estate. The second step is rebuilding your reserves, making sure you have money in reserves, and then max out your 401k and then start investing into stocks. Your Purchase of investment properties really can go right in the middle. It can go once you've purchased a primary residence and you've rebuilt your reserves, because we often deplete our reserves when we're buying a primary residence, then you can decide, hey, instead of maxing out my 401k, maybe I want to start investing into real estate, and I would love to guide you through that decision. I've covered a lot today, but I really, really appreciate it. Thanks, Rosemary. Everybody, I'd love for you to leave me a comment. Maybe tell me what it is you learned the most today. We're going to stay with this slide. Sorry, I got some extra slides here that we don't need to get into. The bottom line is, guys, we are going to, oops, let's go back. I just goofed up my screen. We're going to invite you to come back next week. We're going to be doing continuing our Financial Friday series next Friday. We're going to talk about credits, how to build it, how to repair it, how does credit work, myths and things that people do wrong in building their credit. So we're going to be talking about all of that next week. Please join me Friday, 12 noon on the 15th. And I'll be sharing with you everything I know about credit. Again, guys, appreciate it. Please share this. So whatever social media platform you're on, click the share button, type something like John King's absolutely amazing and you should watch this. It's worth every minute of it. And call him when you're ready to do a loan. I would really appreciate that. I appreciate your guys' trust, and I'm looking forward to being here and answering all of your questions. Have a wonderful weekend, and we'll talk to y'all soon.